Have you ever heard of a company that decided its old business was so broken, it basically lit it on fire to go all in on a wild crypto bet? Well, today we're talking about Greenlane Holdings, and its story is either a masterclass in corporate genius or just pure desperation. Let's find out which one it is. So, what's the real story here? Is this a brilliant pivot to save a dying company, or is it just a last-ditch Hail Mary pass? To figure that out, we've got to look past all the hype and really dig into the numbers. So let's get into it.
Here's how we're going to break it down. First, we'll look at Greenlane's split personality. Then we'll uncover the really shocking financials that force their hand. We'll analyze if the stock is a huge bargain or just a trap, and then finally, we'll give you our verdict and even an alternative idea for investors.
Okay, so the first thing you really need to get your head around to understand Greenlane is that you're not looking at one company anymore. Not really. You're actually looking at two totally different businesses that just happen to be sharing the same roof. And this slide really shows you the two sides of the coin. On one hand, you've got the legacy business, a 20-year-old company that sells cannabis accessories, and its revenue is in an absolute free fall. On the other hand, you have this brand-new crypto treasury. It's funded with a huge $110 million investment, and its entire focus is on stacking up tokens from something called the Berachain ecosystem, which is a new blockchain platform that's making a lot of noise in the DeFi space. So you have to ask, why on earth would they do something so drastic? Well, it's because that legacy business was in a really, really tough spot. The whole market for cannabis accessories has just been getting hammered by price wars and regulatory headaches. So their old way of doing business just wasn't working anymore. This wasn't really a choice. It was a move they felt they had to make. And to lead this massive change, they brought in some serious heavy hitters. The new chairman is Bruce Linton, who co-founded the cannabis giant Canopy Growth. I mean, that's a big name. They also brought in a chief investment officer whose only job is to run this new crypto strategy. And this is a huge deal for anyone who's bullish on the company. They see this experienced team as a major sign of credibility. Okay, now for the numbers. And when we look at the legacy business, well, the data is pretty alarming. It shows you exactly why this crypto pivot wasn't just some fun idea, it was an absolute necessity. First up, revenue. In just 1 year, sales fell by a jaw-dropping 81.7%. I want you to just picture a local store where more than 80% of the customers just stopped showing up. That's the kind of collapse we are talking about here. Now, this next number is something you almost never, ever see. A negative 692% gross margin. What does that even mean? It means for every dollar of product they sold, the company actually lost almost $7. How is that possible? Well, it's because they had to take a massive $5 million write-down on old inventory they finally admitted they were never going to be able to sell. You know, in the middle of all this financial chaos, there is one little bright spot. The company has basically no debt. They did a good job cleaning up their balance sheet, which is a really smart move. But the question is a clean slate enough to build a whole new future on? And that bright spot gets a little darker when you look at this. The business is just burning through cash to stay alive, losing $2.8 million over the last year. It's kind of like having a car that's leaking gas, even when it's just parked in the driveway. It's just not sustainable, and it's why they had to do something so radical. So, okay, we've got a collapsing business on one side and a wild crypto pivot on the other. How in the world is the stock valued? This is really the big debate. Is Greenlane a massive bargain that the market is just completely missing, or is it a classic value trap, cheap for a very, very good reason? Well, if you only look at the price-to-sales ratio, Greenlane looks incredibly cheap. It's trading at just 0.3 times its sales, while its competitors are hanging out around 1 or 1.2 times sales. So on the surface, that looks like a huge discount. But that's definitely not the whole story. And this gets right to the heart of the issue. The bulls, the people who are optimistic, they think the stock is cheap and that the market is totally ignoring the potential of that new $110 million crypto treasury. But the bears, they argue that the low valuation is completely justified because the company is insanely unprofitable, its main business has collapsed, and this whole crypto thing is a pure gamble. And that brings us to maybe the single most crucial point of all. Everything, the entire future of this company now hinges on one thing, the success of the Berachain crypto ecosystem. If Berachain doesn't take off, for whatever reason, Greenlane's entire strategy could go straight to zero. That is a massive, incredibly concentrated risk.
All right, we've looked at the split business, we've stared into the abyss of those financials, and we've weighed the valuation puzzle. It's time to put all the evidence on the scale and come to a final conclusion.
So, after all of that analysis, what's the final call on Greenlane Holdings? Is it a buy, a hold, or a sell? Our analysis, based strictly on the data we have, leads us to a definitive sell rating. And here's the bottom line. The old distribution business isn't just shrinking. For all intents and purposes, it has collapsed. And the new crypto strategy? It isn't a smart diversification. It's a complete, all-or-nothing bet on a single, highly speculative asset. The level of risk here is just way too high to justify an investment right now. Now, one really important clarification. We are issuing a sell rating, but you'll notice we're not giving a specific price target. Why is that? It's because the source documents we analyzed simply don't have any analyst price targets. Our commitment here is to stick to the data provided, and in this case, that specific data just isn't there. But what if you find this whole space interesting, but you agree with us that Greenlane is just way too risky? Well, the sources do point to an alternative company for anyone who's looking for a more stable investment in a similar sector. Just take a look at the comparison between Greenlane and a company called Turning Point Brands, or TPB. I mean, it's night and day. TPB is a profitable, multi-billion-dollar company. They have a stable growth strategy that's focused on iconic brands like Zigzag Rolling Papers. So it operates in a similar world, but without the existential crisis and without the all-in gamble. For an investor who's more risk-averse, it's a much more conventional and, frankly, defensive choice. And that really leaves us with one last fascinating question, doesn't it? In a few years, are we going to look back at Greenlane's move as this brilliant blueprint for how old-school companies can reinvent themselves for the digital age? Or is it just going to become a classic, cautionary tale of what happens when desperation meets excessive risk? Honestly, only time is going to tell. And that's all for this breakdown. If there's another company you want us to dig into, let us know down in the comments. Thanks for watching, and make sure you subscribe for more deep dives.